Hi guys, this is James from McKay Research. I absolutely had to do a video today because the last 24-48 hours have been very exciting to say the least in the cryptocurrency space. Now I assure you that that's not the reason for my hair loss, this was entirely voluntary. But the question that's on the tip of everybody's tongue and is occupying their minds is whether this sell-off that we've witnessed yesterday and again today is going to be the one that actually triggers the end of the bull cycle, and from here on it's downhill from here, so that the bears are finally in. So I'm going to spend the next 3 minutes taking you through some of those charts and give you a very succinct analysis as to why I think what we're seeing here is just a natural correction.
Okay, so I'll just take 2 or 3 minutes here to give you a high-level overview of some of the charts and data that I like to use when looking at the markets. I think it's particularly important when things get a little bit choppy, as they have done in the last few days, to look at the data for that on that high-level overview, just to keep one's perspective and to not get sort of swept up in the drama and the panic. Bear in mind there's hundreds or if not thousands of charts and indicators that you can use. I've just picked three that I use on a relatively regular basis to take you through those and my thinking process. So starting out with the high-level view, this is the global crypto chart. This is the total market cap from CoinMarketCap. Here we can see, again, a picture tells 1,000 words, huge blow-off top spike in market cap here. So from the beginning of January, we were all the way down still in around, what was it, 773 billion market cap, total crypto, US dollars. And already by the 20th of February, we were already up at 1.75 roughly trillion dollars. That is an astonishing increase, and obviously reflected by some of the announcements and energy and investment interest that we've seen around Elon Musk, MasterCard, the first Canadian ETF, and so on and so forth. And so what we can see here on the right-hand side is this tiny little dip here, which actually, in the grand scheme of things, doesn't even look all that significant. That's probably because it really isn't. And that was the dip that we saw in market cap in the last 2 days, and it's basically wiped about 250 billion off the total market cap, which again is a necessary pullback for any market that is looking at that's increasingly showing signs of overheating here. If we go, and this is the linear scale too. If we go to the log scale, it actually looks even less dramatic. So just quickly, the second chart, I think it's always important not to underestimate the power of looking at the Bitcoin chart and doing so using multiple time frame analysis. Now, of course, this is big for people who do day trading and swing trading. But even for long-term, hodlers, I think this is a very useful tool as well, just to get context. So for example, if I look at the 1 hour chart on, this is XBT USD, so the Bitcoin US dollar chart, that huge downdraft here, I mean, it looks really dramatic, like a waterfall almost. So if I take my measuring tool out here, I can see that at the time the correction started, it's around 8 o'clock on the 21st of February, all the way down to the 23rd of February, around midday here. That was a percentage decline of around 22-23%. So it didn't take it very long to shed the price those prices didn't take long at all. But again, if we zoom out and look at what happened in February and in January, it's actually very, very similar. So for example, if I go to the 9th of January, I think it was, we had a similar correction back here. Again, take the measuring tool out, you can see that it was of a similar magnitude, even more so. So this is about a 25% move between January 9th and January, and the 11th of January. So again, in context, this move isn't all that significant. I think it's people a little bit more shocked as the momentum was building up in the market to a degree that people are starting to think that nothing can get in its way and it will levitate forever. But these corrections are a necessary part of any market, particularly one that's still sort of undergoing a series of price discovery corrections that we know that Bitcoin is. So again, very important to zoom out, look at it in context. Multiple time frame analysis always helps here, and we can see if we do that, we can quickly spot the fact that there are many such corrections that have happened even within this year, let alone in previous years. Okay, so the next chart that I'd like to go through quickly is the relative unrealized profit loss chart, the RUPL you can call it. Some of you will be familiar with the NUPL chart, which is the net unrealized profit loss chart. They both do similar things. They're both really a measure of longer-term sentiment in crypto assets. This one's done by lookintobitcoin.com. And really the key principle, as they describe it, of this chart is to look at the ratio between the overall market cap of Bitcoin and the number of investors taking profit. So in other words, when the market cap rises faster than profit taking is occurring, then that's a pretty good sign that the market is overheating. And at that point, you can say that you'd be in this red band here, which is sort of signifies the investor greed area. And so you can break down percentages of Bitcoin relative to the unrealized profit loss to find out what sector, what stage of the market we're in, and which is obviously helpful for your strategic planning. So here we can see that massive correction here in 2018. Of course, we're all familiar with. We were well into the greed phase. In fact, as measured in percentage terms, at the peak before the downtrend at the end of 2017, 2018, we hit a RUPL value of 79%. And previously, the previous crash in 2014, the peak was in the 80s. Now, why I point that out is because here, to the present day, we're still in the 70s here. So that actually means there's still some way to run until we actually reach the sort of peak greed, if you want to call it, that we saw back in 2018 and prior to the crash before that in 2014 as well. So yes, the profit taking is not in any way surprising, and also it's good to see that in terms of the sentiment. Yes, we are getting into the greedy phase of the run, but we're not quite there yet in terms of where we were in previous bull cycles. Okay, so no analysis would be complete, of course, without looking at some on-chain data as well. I always like to go back here because I know that this is the one area that's obviously specific to crypto markets. There's no equivalent in equities or commodities, for example. I mean, I really see this as the equivalent to financial analysis or balance sheet analysis in stocks and the tracking of physical product flows in the gold and silver market, for example. So looking at this on-chain data, Chainalysis have got some great charts here that I recommend you guys check out. So here we have, for example, the Bitcoin inflows to exchanges. Now here the logic, of course, is that as the deposits on exchanges from wallets increase, that suggests an increase in selling pressure in the market. And it's actually quite a reliable indicator because if we look at here, for example, on the 27th of January or 28th of January, we have 3,700 million roughly of inflows, and this almost doubled for the next day. And then that just basically dropped off a cliff for the following day. And here we can see, if we go back to our Bitcoin chart, on January the 29th, that actually coincides with this peak here. So this is where we had the inflows, and that's where we had the selling pressure come in. So it always takes about a day, a little bit over a day for on-chain exchange inflows to translate to a decline in price levels. So here we can see that ended up being a drop of around 13-14% here. Okay, so the other metric that I like to look at on this page is the difference between crypto to crypto exchange flows and also crypto to fiat flows, which is this chart here. So exchange between Bitcoin flows. So they explain here that if we see a pickup in activity of crypto to fiat exchanges, that means that people will typically be depositing crypto onto an exchange for cashing out into fiat. Whereas if we see an uptick in the crypto to crypto flows, that just means that people are likely going to be increasing their positions either for trading or speculating or just for hodling, in fact, but not for selling. So here we see that there's a huge difference between the crypto to crypto flows versus the crypto to fiat flows on chain. Okay, and this is the 7-day average. So this really massive sort of obelisk here tallies with the type of selling pressure we've seen in the last 2 days. But again, many times you'll check back here and the difference between these two columns is significantly less. So again, no surprises about the selling pressure. A lot of this data really suggests to us that this was just a question of profit taking, and there's nothing really much to see here or to panic about.
Okay, guys, so I hope that helped to show why I at least think that there's plenty of energy left in the markets and that the bull run will be sustained well into 2021 despite these large corrections and pullbacks. Now, anybody who's involved in the space will know that these large corrections are par for the course. And in previous years, of course, we've seen much larger pullbacks, 50, 60, 70, even 80%. So 20% is normal, and in fact, we should be grateful that these pullbacks and corrections happen, because it just, in a way, helps to maintain the health of the market. Because if there are no pullbacks when the market did eventually turn, it would make the bear market that followed very, very nasty and difficult indeed. So actually the reason I wanted to do this video was for another reason though, one that I actually think is more important. Now, in times like this, there's a lot of fear, uncertainty, and doubts that arise as a result of these market corrections and pullbacks. And I think that it's a really good time to further examine why it is that you or I got involved in this space in the first place. Now, for many people, of course, that is to maximize returns on investment. Some people, of course, want to make fast and easy money. But for other people, I know, and myself included in this, of course, that there's a real interest in the underlying technology. I mean, for me, I've always been interested in the ability of Bitcoin to facilitate this value transfer between a network of distributed participants. And I think it has real potential to disrupt the balance of power between the individual and the institution. I think that relationship is very much lopsided towards the institutional end right now, and I know that also many business leaders and business persons are of the belief that blockchain has immense potential to streamline their workflows and make it more efficient and cost effective. Now, in closing, I wanted to finish with a point that helps me contextualize this entire issue around where we find ourselves in the marketplace right now. And that is thinking about the $1 trillion market cap in crypto that was achieved last week. Now, when I first got started in Bitcoin and crypto about 6 years ago now, I remember reading a lot of articles about the pending arrival of the $1 trillion market cap, and how that would herald sort of a new era of Bitcoin acceptability and respectability as well. And in many ways, we've actually seen that play out, because in the last 2 or 3 weeks, we have seen almost an unlimited supply of announcements from big business and financial institutions about their participation in the space, from Elon Musk to MasterCard to an ETF being launched in Canada, etc., etc. Now, the question that I would ask here is that has all this institutional and organizational investment and interest in Bitcoin not taken it further and further away from what it originally set out to be? Now, it seems to me that Bitcoin is rapidly becoming the de facto gold standard currency for big organizations and investors as well. And it seems to me this is fundamentally at odds and is a paradox to its original mission statement. It was designed to be a counterweight, or something that could mitigate against the excesses of the financial sector that caused the 2006-2007 crash. And it's now, it appears to me, being co-opted by those same forces and institutions, even though they're not all uniform and all the same. So now over to you. I'd love to get your thoughts on this obvious paradox. Do you think that this is a good thing, all the institutional investment and the fact that Bitcoin is rapidly becoming the sort of de facto corporate currency? Or do you see it as something that we need to get away from, and that there needs to be a renewed focus on the underlying technology and the disrupting power that it has to shape our futures. So please leave your comments below, and I will see you all in the next video.
If you enjoyed this video, please like, share, and subscribe. It would really help the channel grow. And don't forget to drop a comment on this or related subjects in the comments section below. Thanks for stopping by.